does not exist. Click settings, save location. Oh. Recordings. Yes, go to the audio. Okay, I hope it will record. Good day, ladies and gentlemen. Welcome to the Standard Bank webinar hosted by Standard Bank Financial Consultancy, SPFC. My name is Katie Ogunene, the host, and I apologize for us being late. We've had some technical glitches. 2020 is trying to be rough on us, but we won't let it. Since it's the first conversation we're having with you this year, compliments of the new season. I think we can still say that until the first quarter ends. I hope so. Apologies again for being late, but we're going to get right into it. I just need a small favor for people who are on board, just to give me a signal that they can hear me so that we can continue. There's a small high five on your screen. It's on the panel on the right-hand side of your screen. If you can click that for us and acknowledge that you can hear me, then we can carry on as soon as we can. So if you just see that small high five on that panel on the right-hand side, thank you, Zikona. All right, so we can, yes, thank you, Wipcare. Thank you, Rose. Thank you, Peter, Patrick. Nyagalo Norman, okay, high fives are going up so you can hear us. Okay, so hopefully we won't have any glitches during the session. Today we're talking about, have you claimed your retirement tax deductions yet before the end of the tax year? If not, we're going to talk about it and assist you with that. If you have any questions during the session, on that very same panel where you clicked your small high five, there's a questions box. If you type your question in during the session, at the end of the session, we'll try and address those questions for you and address those. So today, my speaker is our one and only resident DJ. If this is your first webinar ever with us, you might not know him, but for the rest of us, we know him, but I'll tell you a little bit about him. It's Mr. Errol Mayer. He's our speaker. He's a certified financial planner and an admitted advocate of the High Court SA. He holds qualifications in finance, law, teaching, and taxation. He has written many tax and financial planning related articles, newsletters, and study material for corporates, financial institutions, and universities, but he's also authored a book, Notes on Estates and Financial Plans, now prescribed for most universities that are doing financial planning. He's a renowned lecturer, examiner, and moderator for various universities in South Africa. He previously worked as a legal advisor for corporates and as a tax advocate for our big SARS. He currently holds a position of advisory propositions legal specialist here at Standard Bank. That's Mr. Errol Mayer. He's going to take us through the presentation today. So I'm going to hand over to him. Errol, good afternoon. Thank you so much for your time and good luck.
Okay, thank you, Kitiwe, and good day to all of you. The topic today, claim your investment tax benefits before 29th of February 2020. So let us see, first of all, what is the agenda? What is it that we're going to do? First of all, I'm going to start off and say, well, what is important? You've got about 2 weeks left in order to qualify for these benefits. So this is for the tax year ending 2019-2020, which is on the 29th of February. I am going to talk about retirement annuity contributions and tax-free accounts, because those are two very popular vehicles that we use in financial planning and in estate planning. But since I'm not going to discuss products, I'm going to talk about the tax aspects of these solutions. And therefore, I'm going to compare the tax characteristics. And the intention is not to determine which one is best from a tax perspective, because that is not the way to go about it, and that is what I'm going to demonstrate. But we need to understand the tax characteristics, and we're going to compare the retirement fund contributions or the retirement annuity and tax-free savings accounts. Then I'm going to make use of very practical examples so that we can understand how to go about it. Obviously, it can become far more complicated depending on the sources of income and the tax calculation, but I'm going to hone in on that is important for our purposes. And then I'm going to do some general tax observations that we've never done before and play around a little bit with tax. But I want to remind you, this is not about tax as such, but where does tax fit in financial planning? So a couple of aspects in order to do so. First of all, on the tax year ending 29-2020, I think it's important because on the 26th of February, we're going to see the budget speech. So once we hear the national budget, what is happening, that correlates directly to what we are doing. If it's going to be that we're going to get tax relief, or it's going to be that we pay more taxes, we have no idea. We have some ideas and suggestions that are here out in the media, and probably true. But the point is, it is a very crucial date for us, because we have to do our own personal little budget. And that is what remains after paying basic expenses and having disposable income. Now, tax is a great cost. So wherever we can save on tax, but it fits the risk profile of what we're trying to do with our budget, then the two of them can work hand in hand beautifully. So the high marginal rate of tax, 45%, is fairly steep. And people will be speculating whether it may go up or not. Well, let me remind you, years and years ago, is right about the 1970s, the rate went up at one stage 50 to 60%, dropped down to 45, and then we were fortunate, dropped down to 40%, and now we're back at 45%. But that is not really the issue. The issue is this: from a tax perspective, if we can claim a deduction on an investment, where investment by its very nature, you should not receive benefits from a tax point of view because it's a capital expenditure. But some exceptions were made in the tax laws, and that is a retirement annuity. Now, if you pay a high marginal rate of tax and you claim a deduction, you're actually reducing your effective rate. And that is a new concept I'm going to talk about and say, to what extent can I reduce my effective rate? And then later on, I want to say, now, well, that's fine and well, I get the deduction, but one day I've got to pay the tax. We hear that all the time. Is that the same? No. We're going to talk about a little bit about tax arbitrage, because if I can get a deduction up front at a high effective rate and I pay tax at a lower rate later on, and there were no taxes paid during the build-up to the investment, from a tax point of view, that is actually a very good deal, and this is where we are. So we're going to analyze that a little bit. So tax break, give or take away, you be the judge of that. What do you think? But I am fairly confident that we will have to look at our priorities and expenditure, that's from a personal budget point of view, and make sure that we still are able to afford those dreams, those retirements, those education of our kids. That's not going to go away. So the problem is, it's not about the problem, is how can I solve this problem in my personal circumstances? And when we talk about taxes and these solutions, it definitely is a strategy to explore and say, how can I, instead of complaining about the problem? So this is what this lecture is about. How can I? Then contributions must be made before the 29th of February. A very simple rule: you snooze, you lose. If you claim it in the March, it's too late to be paid. You cannot. So make sure that you do that final planning before the end of the year and see what is the maximum that you can contribute. And what would happen if I contribute more? If I contribute less, well, then you snoozed. If you contribute more, well, there could be some relief. And then finally, some observations about retirement funds and tax-free investments. Right, so let's have a look. Budget speech 2020, tax increases for natural persons. Is that going to happen? There are speculation. There's very little room to maneuver. Maybe a VAT increase? No, there would be a problem because that hits at the disposable income and it hits the poor. Is it possible they can increase the marginal rates? Not sure. Is it fairly likely that they're not going to increase the rates with inflation? Well, that is a very real possibility, and that's a technique that was used last year. Well, they may perhaps add on a levy, which years ago they did very effectively, just to add another 5% on the top earners, just for the year, because that could bring in very quick cash on a short term. So I've seen some rumors in the media, and that's not impossible. The point is, we're speculating. The point is, at the end of the day, we're going to crunch the numbers and we decide what we have to do. So income tax, we can look at the tax brackets. Capital gains tax, at the moment, there's a 40% inclusion rate, and I'm going to demonstrate that lately today. Will that be increased? Well, it used to be 25, it's 40. If something could happen, then it's possible they can say, well, it can move up to 50, the inclusion rate, which means you're going to pay more tax on those capital assets that you're going to dispose, for instance, such as collective investment schemes. But if you had those funds in a tax-free investment, as I illustrate later on, you will not be affected. And this is why it's important to understand all these taxes, which is not only about income tax, it's about all the taxes. And that applies to estate duty. So if you don't pay estate duty, oh, that's wonderful, but what does it mean? It means that, for instance, in the case of a retirement annuity, you don't pay estate duty on your proceeds. It means that more monies are available for your dependents, because that also is important. It's not only about you. So if you don't pay estate duty on a retirement annuity, you can save up to 25% where the rates are at the moment. So you've got to consider all these taxes before one would say, well, which one is the better, tax-free investment or retirement annuity? So what can we expect of the budget speech? Well, let's wait and see, but I tell you, and once we've heard, we will be able to fine-tune some of those strategies, but it's not going to be a new strategy. It's going to be basic financial planning and budgeting is going to be the answer at the end of the day. So let's quickly have a look at the characteristics. When we look at the retirement fund and we talk about the retirement annuity, what is essentially happening? It is an investment, and usually on investment, it's not trade expenditure. You can't claim a deduction, but the Income Tax Act says that you may claim a tax deduction. So let's look at the situation from the cradle to the grave. If I make a contribution to a retirement fund, well, the trade-off, you're going to get a tax deduction, but you can only take your monies at the age of 55 or in the event of death. And we'll explore those scenarios as well. But if I make a contribution, I'm entitled to a certain limit, I get an actual income tax deduction. So if I'm at a 45% marginal rate, I technically get up to a 45% relief. Therefore, I refer to this often as the tax neutralizer. You will see that capital gains tax, if in a particular year you sold the asset and you made capital gains, you can even include that amount in order to do the calculation so that you can claim quite a substantial amount in that particular year of assessment. So capital gains in the year of assessment can actually enhance the maximum amount that you can contribute and qualify for tax relief. This is an aspect not often understood by many people out there. So if you made a capital disposal, let's say unit trust, and it wasn't a tax-free investment, can I use that amount to incorporate in the deduction? Yes, and I'll illustrate to you later on. Well, back to my story. Now, what happens at maturity? Well, here it goes. You got a tax deduction up front, so you must expect at the moment of death, or when you retire from that fund, usually after the age of 55, or when you retire from your employment, you can take up to 1/3 you can take in cash. If you take the 1/3, there's a retirement tax. But if you don't want to take the 1/3 and you want to get an annuity from that, there's no retirement tax. So here again, we've got some options later down the line. As I mentioned earlier, with the retirement, there's no estate duty. So when you start doing planning for your families and for your family and your descendants, how much money are left over for mommy and the kids or daddy and the kids, then you know at least there is that pickup of 25%, 20 to 25% that you don't have to pay. And here, with the retirement annuity at death, there is no capital gains tax that you have to pay. And that, over a long period of time, can make a difference. Well, let's compare that now to a tax-free investment. Now, a tax-free investment, the positive side of it is that you're not limited to a 1/3 and you can take it whenever you want. So we refer to this as discretionary monies. But when you make the investment, there's no tax deduction, but the limitation as to how much you can invest. So at the date of death, or when you want to take your funds at any stage, you can take the full amount. There's no 1/3 limitation, but there will be no capital gains tax. However, there will be estate duty payable. Now, you've got to make pretty sure, as I'll demonstrate later on, that you get that capital gains tax benefit, because if you don't get the benefit because of the way that you structure the investment, it is actually meaningless. to have a tax-free investment, and I'll demonstrate that. So there we go. With the retirement fund, you can claim the deduction up front, you get immediate tax relief, but you will pay tax at a later stage when you mature from the fund. The question is, it's going to be more or less tax, and as I will show, the effective rate likely to be much lower. And with the tax-free investment, there's no capital gains tax at maturity, right? So there we've got two vehicles there. Let's have a quick look at the tax rates. It is the current tax rates. And you'll see that the person where his income, his taxable income, that it says taxable income, doesn't exceed 195,850. The rate of tax would be up to 18%, and there's a certain threshold that you won't pay any tax whatsoever. So that is an 18% rate. Moving to the highest rate, if your income, your remuneration, your salary, your taxable income would exceed 1.5 million, you will pay 532,041 plus 45% that exceeds 1.5 million. The question is, do you really pay 45%? And this is where we're going to look at the effective rate. What are you actually paying? Right, so let's do a simple example, because all I want to do is to show the impact of the retirement fund, retirement annuity, pension fund, provident fund. What is the impact of that deduction? So let's assume a person earns a salary. Let's make it simple, ignore the fringe benefits, travel allowance, etc. Let's make it simple. And it's a salary of 1,272,727. I chose those figures specifically. So how much tax would I pay? Taxable income, important concept, would be the same amount. And if you can follow my cursor, it will go into this band, which means you'll pay 207,000 plus 41%. That exceeds the 708,000. So if I do this calculation, you'll see the tax payable would be 438,000. It's a massive amount. What is the effective rate? Now, I didn't take the age credits and medical expense. I didn't take into account, just to make it very simple. But the effective rate, which is actually a little bit lower, because you're entitled to the age credits, is 34%. So even the margin rate is 41%, that is what he's paying. So if he would make a contribution to retirement annuity, that's actually what he gets. So let's see if this person would contribute to retirement annuity. Note there, 34.5% is the effective rate. If I want to contribute to annuity, I'm entitled to, you take the total remuneration, which is the taxable income, 27.5%. That's rule number one. 27.5%, that gives you 350,000. This is what this person can claim. Now I chose that figure specifically because you are limited as to how much you can contribute, which is 350,000. Now you'll be able to work it out very quickly. A person that earns a salary of 1.272, as I've illustrated there, he's up to the maximum. So a person cannot, if he earns a salary of 1.5 million, you know already he will be limited to the 350,000. Okay, fine or well. But let's now claim the deduction. So there's the salary, same of 1.2 million, less the retirement fund deduction. His taxable income has decreased to 922. If I go now to the same tables, 922,000, and I slot it in here, you'll see the tax payable would be 295,000. That is a considerable saving. Another way of measuring is, see, the effective rate dropped to 23%. That is substantial. One of the best deductions that any person, be it in business or not, can claim. But it comes at a price, in that at maturity, you're going to pay the tax. The real question is, that tax, will it be higher? Chances are that it may well be lower. And we'll do a calculation. Right, so now you have a basic understanding how to calculate the retirement annuity. So let's make use of another example. Here a person has a salary of 600,000, taxable income 600,000, tax payable is 165, the effective rate is 27.53%. If he would contribute to a retirement annuity, what would be the maximum? 600,000 multiplied 27.5 is 165,000. Very simple. This is how majority of cases will be dealt with. Is it more than 350? No, it's not. So you're entitled to claim that deduction. Now, if you would contribute more, it's not the end of the world. In the following year, you'll get a credit for that. Good. So let's apply that. And how would it change his tax? His salary is 600,000. He claims up to 165,000, which is a massive amount. It reduces his taxable income, and look at the effective rate of tax, 18%, 17.41. So he has reduced it substantially. Let's spell it out. What has happened is that additional cash flow is available to a person because of the contribution to a retirement fund, and the full amount is invested. If you invest it in simple unit trust or a tax-free investment, you wouldn't get that reduction in tax. So the cash flow advantage, and go back to what I said about budget speed, it's all about what are your priorities, and to improve your cash flow, seeing that maybe the VAT is high, the taxes are high, inflation is not making provision for. Because of all these factors, you have to be a little bit smarter. Now, if your goal is to retire, then a retirement annuity is a very suitable vehicle for that, because it helps with the cash flows. Right, so let's do, I chose 3 examples. With these 3, I think we're 99% ready to pass any exam on income tax when it comes to retirement annuities. So here we've got a person of 1.5 million. Let's assume he has trade income, like renting out the house, or he's part-time taking divers out and charging them a fee for a chartering fee, etc., whatever the case may be. So he's got a trade income that's not related to his employment. Therefore, his gross income is 2 million, but his deductions, because he has to service the boat, the engines, etc., let's say it's 200,000. Those deductions are trade expenditure. You can claim it as a deduction. Now, note in cursive, your taxable income before capital gains is 1.8 million. But let us assume that this person sold an asset for a great profit. And because he did that, when you do the calculations of the inclusion rate and you subtract the base cost, usually the purchase price, you get to a figure of 400,000. Then that 400,000 is capital gains that's added to your taxable income. And this is what I was referring to with retirement annuity. Can I claim that as well for a retirement annuity? And the answer is yes. So therefore, this person's taxable income is 2.2 million. Now here goes the rules, and I'm spanning a bit. How much can I claim for a retirement annuity? 27.5% of the greater of his remuneration, which is his salary, or taxable income, which is in the blue there, which includes the capital gains. It means that he can claim 605,000. That's massive. But what is the rule? You are limited to 350,000. So now you can see that this lower income earner can actually claim a deduction against capital gains, because this was a high income earner. So let's do that example. First of all, let's just show what is the impact of that. So there's a retirement fund contributions, 350,000, and that's how I would do the calculation. So my actual tax would be payable would be 689, where initially it was 847. I jumped to the previous slide. 847 at the bottom, the total. Now it's reduced to 689. Good. So you can claim to a maximum of 350,000. Okay. So let's scale it down. What if a person only earns 200,000? And one would say about 27.5, and I've calculated there's 55,000. But he made a huge capital gain that year. Then this is how you calculate it. You look at the 200,000, which is gross income. You add the capital gains of 400,000, so his taxable income is 600,000. Therefore, he can claim 27.5% of the 600,000, which is 165,000. And this is where people go wrong. And I often see newspaper articles where this is not fully understood. And the comments that one would often see that people are making. And we've had that. So in this particular instance, he can claim 165,000. Is that less than 350? Yes. So you may take that. There is one more rule. It may never be more than what I've got here in cursive, which is 200,000. But that's not a problem because it's less. So there's a typical example where a person with a lower salary who's made a capital gain must explore and say, what cash flow advantage can I get because I had to pay capital gains tax? Okay, so just to illustrate the last point is, let's say I received no salary for that year and I only made a capital gain. The question is, can I contribute to a retirement annuity? Well, yes, you can, but can I claim a tax deduction? Well, let's apply my rule. 27.5% of the greater of the salary, remuneration, naught, or of taxable income, which is 400,000, which is 110,000. But this is where SARS is going to step in and says, no. We have one more rule. It may never be more than what is in cursive here, and that is naught. And that explains why this person will not be able to claim a retirement annuity if you only made capital gains. Because effectively, we will be claiming against capital gains, which goes against the spirit of capital gains. So that is the third proviso that seldom kicks in. Usually, you'll find a typical scenario. Go back to the previous slide. It's where the salary is 200,000 or 300, and it's a huge gain. Go and explore whether one can claim a huge deduction for retirement annuity purposes. Okay, so that was the contribution. Now, a person in a moment of death. So here are the retirement tax tables. Now you've got to pay tax because you received the tax benefits. And there's the table. If you exceed your lump sum only the lump sum, that's the 1/3 in event of retirement, will be taxed up to 36%. So let's do a quick example. Now let's assume our client had 3 million benefit and he decides to commute 1/3. You can take up to 1/3, 1,000. You'll go to the tax tables, and remember this is aggregated with previous amounts depending on when you got that. It is aggregated, and the tax payable is 117,000. What is the effective rate? 17%. So when you talk about the real tax planning, tax arbitrage, we got a huge deduction in a tax-free environment, and the effective tax at the end of the day is very low. It is 17% on the lump sum. That is not a bad deal. But what in the event of death? Well, in the event of death, you can take the full amount as a lump sum, but then you're going to pay more taxes. So let's assume the person exercises that option. And remember, this is available before retirement. Death occurs before or after retirement. So you will do the tax calculation again. You'll go to the third band, and we'll see that quite a substantial lot of taxes payable, 832,000. But the effective rate is 27.5. So do you remember earlier where I showed where the person earning 1.5 million can get up to the 30% a tax deduction and a reduced effective rate, which was great for that person. But did you remember also where a person that was contributing 600,000, his effective rate was much lower? I don't think this is often observed, but to my mind, this is actually penalizing the person who didn't earn a lot, got a huge lump sum payment, and now he's going to pay more tax. So that, to my mind, is a little bit unfair, but it is still favorable to all parties out there. So if I must say, I would say that the tax incentives for the middle class should be better, because this system quite clearly demonstrated by me is the very wealthy who would earn a 1.5, 2 million salary, who really doesn't or may not have that huge retirement problem, yet he's getting massive tax break. But that's the way it is. Let's talk about the estate duty. Now, with the retirement fund, there's no estate duty payable, so that's a saving up to 25% in the event of death. In the event of a retirement annuity, in the event of death, there's also no capital gains tax on that. So retirement annuity just about escapes all the taxes except for the retirement tax, and when it's taxed, it's used as a very favorable rate compared to all the taxes that you have paid. So let's talk about the tax-free investment. No tax deduction. From an income tax point of view, you may only contribute up to 33,000, but you may not contribute more. You will be penalized if you do that up to 40 or with 40%. But you can contribute up to a certain amount, and the spin-off is that at maturity there will be no capital gains tax. So what's the simple rule? Make sure you choose an investment which normally would be subject to capital gains tax. Don't choose an investment that won't have capital gains tax, like an income fund over a short period. What are you doing? Achieving no benefit whatsoever. So here's a typical example of where one should look at financial planning considerations. The concept like term and inflation and capital gains tax being paid on the compound growth and many years down the line, that is where the real value is for a tax-free investment. Good. So tax-free account, the characteristics: 30,000 per year, 500,000 for a lifetime contribution. It would be great if that could be increased, but really it is not that important. I think people are more concerned about budgeting and prioritizing expenditure than saving so much. Tax breaks 10 years down the line is not what's going to matter. It's now. What can I get now? On the growth itself, there's no income tax, dividends tax, or capital gains tax. Why is that important? Because the investment can accumulate so much farther. This is the value of compound growth. So all the assets being compared, it's got that additional assistance in that there's no tax in the fund. And that is for a tax-free savings account as well as for a retirement annuity. There's no deduction for a contribution, which I've said, and it's ideal for medium and I would prefer longer term goals. This is for a specific goal and very useful after the date of retirement to supplement post-medical expenditure. This is a beautiful asset to make use of. So there's no short-term tax savings. Let me tell you why. If one would take 33,000 over 3 years, you'll accumulate 99. Let's assume a 12% growth. It's a very good investment, but let's assume that capital profit, that is your maturity value less what you've contributed, that's your base cost, 25,000, but 40,000 is excluded. So it falls under the exclusion. So really, what have you achieved here? Nothing. So a tax-free investment for a short term, you're just using up for no reason whatsoever. But let's compare over the longer term of 15 years. Then that investment would be 495,000 contributed over the term. Remember, it cannot be more than 500,000. Here's an example. And then once you've reached that amount, you can leave it for another 10 years. No one says you must take it. It can grow to 1.5 million. It doesn't matter. Plus the 12% growth is 1,377. And the capital profit in this instance is 151,000. So that capital profit, that is the capital gains. So you get 151,000 more compared to with any other unit trust. So over the longer term, it is an absolute no-brainer to go for the tax-free investment. What about tax avoidance? Now, I thought to include this one because the first question, if one is a bit creative and say, well, yeah, I've got, it's daddy, it's mommy, and I've got 3 kids, and I want to provide for their education. So, well, why don't, daddy, you take out 33,000 and take 33,000 on each child's name? Just okay, well, fine, well, can I do that? Yeah, of course you can do that. But you can't just give money to your child. You actually have to donate it. So when you donate it up to 100,000, you don't pay any donations tax, which is another tax. So it's fine and well. Each child has got its 33,000. So when that child reaches the age of majority or 19 or 20, is going to go to university, that could pay his university fees. Right? So one may say, will that make sense? Well, is the child going to pay capital gains tax at the later stage? And there is a risk that one could argue that that capital gain should be added onto that of the parent. Now, the law is not quite clear when the intention is clear. Can it be done? Well, the way the law reads, it is a possibility if the child would take the monies while he's a minor, that's under the age of 18. So to overcome that, you simply take it at the age of 19. But my question is, did you really achieve something? Because chances are that that child is not paying any capital gains to be a taxpayer in his own right. And here comes the big thing. So he may have looked at it from a tax point of view, realized he didn't gain a lot. But this child has grown up. And he says, well, I'm not going for education. I'm going to buy this new Spitfire, Mustang, or whatever the case may be. So all those factors one has to take into account. So it's very easy to say, oh, put it in my child's name. Apart from it sounds good, one has to think it through and say, really, is that worthwhile? And the same applies to if you would put it in your spouse's name, but I think here the anti-avoidance provisions is going to be very difficult to apply. So all in all, I don't think that tax avoidance is a big thing, although the law is not clear. In the case of income tax, SARS has said quite clearly, oh, you can put it on your children's name. We won't have a problem, but they never said anything about the capital gain, which is what it's all about. So one should be a little bit wary, but I would be not to be concerned, because you just wait until the child has attained the age of 18, then he's not a minor anymore. All right. Having said that, it comes to the end of our presentation. Always remember, why is it that we are doing? It is our little balance sheet in life. It's the assets versus liabilities. On the left-hand side are build up by the assets, and the right-hand side is giving purpose. So here in the quadrant that I'm showing here, this is your passive investments. This is a retirement annuity and tax-free. Always, always, always your point of departure is, what do I want to do with it? And not the fact that I get the best tax advantage is going to help me get there. No, it's about how do I utilize the tax, setting my goals, and then choose the appropriate vehicle. I'm not talking product, the appropriate vehicle that can give me cash flows, which sometimes comes with a restriction how much I can take later years. Can I live with that? And that is what financial planning is all about. Katiwe, over to you. I don't know if there's any questions. We've got about 3 or 4 minutes.
Thank you so much, Errol. I'll check that. Right. Again, ladies and gentlemen, apologies for the delay in the beginning.
Okay, shall I take it, Katiwe? Can I claim a tax deduction for lapses since I am a financial planner? You snooze, you lose. That's the simple answer. As I said earlier, you've got to claim the income tax assets. 11K says you've got to pay. Usually in tax law, when there's incurral of an expense, the legal liability is there, but you haven't paid it yet, then usually we talk about carryover. But when it comes to, funny enough, to retirement funds and investments, it must be paid in that year of assessment. Are these salary calculated only based on gross only or on annual salaries? Well, the Act talks about remuneration, and remuneration would include your fringe benefit. For instance, you'd be contributing to a pension fund. That is a fringe benefit that's added onto remuneration, as defined in the 4th schedule of the Income Tax Act. So it's a total remuneration package. I usually say that what pay as you earn is claimed from. As opposed to that, you get trade income, and that's where you would get income from renting out the house or some secondary income. So if I'm trying to think what you're asking, when you say gross, yes, there's no deduction. Gross is everything that you can think of. And to make it simple for you, think of what I pay as you earn is deducted from, and that will give you a good answer. Okay. Yeah, and that's it.
All right.
I've got that question again.
Thank you so much. Thank you, Norman and Patrick, for those questions. Ladies and gentlemen, if you'd like to continue this conversation with the financial advisor and get more information to help you with your tax deductions, please walk into any Standard Bank branch. There should be a financial planner, financial advisor sitting in the branch. If not, you can SMS the word guide, that's the word guide, G-U-I-D-E, to the number 31791. That's the number 31791. If you just SMS the word guide, a financial advisor will be in touch with you. Or you could email SBFC voice and digital at standardbank.co.za. That's SBFC voice and digital at standardbank.co.za, and a financial advisor can be in touch and assist you with those. Thank you so much for your time. We apologize for being late. We tried to finish on time so you can carry on with your day. Errol, thank you so much for your time as well. Let's see. Yes, Claire, can the presentation be shared? There will be a thank you note that will come out in about 2 days' time with a link to our Standard Bank YouTube channel. That's where all our webinars are saved and stored, and you can watch all the webinars that we've recorded previously, as well as today's webinar on the Standard Bank YouTube channel. Thank you so much, guys. Have a good day, and we'll see you on our second one for the year. Claire, you're welcome. I see your thank you. All right, good afternoon.